Coming into the year, then they got crushed. Now they're doing well. How do you keep track of all of it? We'll do our best. This is Bloomberg. It's Friday, the 14th of April. Hawks on both sides of the Atlantic take off. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
I'm Danny Berger in for Guy Johnson. Alex Steele is in New York, and the euro, what was soaring higher this morning, has now turned into losses. Behind it is the American data we've gotten, the UMich survey, retail sales holding up for the most part. Strong banks, all of those suggest that Waller's hawkish message might come to fruition. And despite hawkish ECB speak, the euro isn't able to hold up its gains. It was at a year high. It is now down on the day about 0.4% versus the dollar. Two-year yields in Germany, those still move higher, 8 basis points this morning, not as big of a gain as we're seeing in the front end of the U.S. curve. But one trend that is sticking, the strength of the Paris stock market. The CAC 40, that is up 0.5%. French stocks easily trading at a new high. We've had a lot of luxury goods earnings. They've been really strong thanks to China. That's what's lifting the index currently, Alex.
Yeah, I was also interested to hear that the U.S. was also pretty solid for them versus an LVMH thing. Anyway, here in the U.S., Danny, you kind of mentioned it. We see softness here in the overall index level, but the best performing stocks in the S&P comes from financial. Just take a look at the S&P Financial Index, up by 1%. Takeaway here, these banks are making a lot of money, and they're setting aside money for some losses and a build in reserves, but they're calling it normalization, right? Getting back to that pre-pandemic versus something actually wrong in the economy right now. They all don't sound very positive, but their actual numbers are. Now, what's really dragging down, say, the Dow and the S&P is Boeing. It's the second worst performing sector in the S&P. They're pausing their deliveries of the 737 MAX. We'll get to that in a second. They have to make some repairs going all the way back to like 2018, 2019. That's going to cost a lot of money, so we'll talk about that in a second. Now, we got the data out, retail sales, UMich, and you really saw yields picking up steam to the upside, definitely on offer. That front-end 12-year yields, 12 basis points higher. And I just did want to highlight gold because I really thought we were going to make a run at the record high today and really have a solid breakout. Now we are solidly below that, down about 50 bucks from a record high. But that's been a really nice barometer of any kind of fear in the market, Danny.
Well, Alex, I mean, the market has been a really difficult one. We were just talking about this before the break, this idea that banks are what's leading the market today. Last month, they were what was dragging the market. It was tech that was outperforming. American equity has been a very confusing story, as has the economy. But the European equity market may be more clear-cut. I have a normalized chart of European stocks and U.S. stocks. Europe is up on the year. It's up 1.6%, while U.S. stocks have fallen. The S&P 500 is fallen. In there are some clues about the contributors to what is keeping the European engine running. We were just talking about luxury goods. The fact that China has reopened and has given a boost to these luxury companies shows some strength that is existing in Europe, and why we see ECB officials, Alex, who say we need to keep hiking. The job is not yet done.
Yeah, and it's unique because you have a close proximity to China and strength in China, but you also have a closer proximity to the energy crisis and Ukraine war. So kind of weighing those at the same time. So I'm saying, hey, U.S. is actually where you want to be in terms of safety. So it all depends on the economic outlook. Unicredit's Eric Nielsen joined Bloomberg Television from the IMF meetings and got his take on the economic impact of economic policy.
I think the whole narrative of economic policy making and who runs the show today has changed. Or is changing. It's changed now. And this is not. So then we can talk about the growth. Maybe global growth is going to be 2.8 or 2.7%, and maybe the neutral rate, it's going to come down a little bit, and the central bankers don't like it, right? And they kind of think, now we're going to tighten monetary policy. That's a sideshow. It's a sideshow. It's not the real story in the real world. The clients we talk to, European corporates, other corporates, are like, this is not what they talk about. This is inflation is coming down.
So the real world data may be different than the official data. It brings us to our question of the day. Recession, delivered, delayed, or denied? Joining us now is Chris Waitling, Chief Market Strategist and Founder at Longview Economics. Chris, when it comes to this European economy, what say you?
Oh, I think the recession is coming. It's on its way. Whether it's a Western recession or European recession. I mean, clearly what's happened is China's reopened. That's added a bit of a bid to the sort of global economy, particularly in Europe, as you say. It's got a lot of trade links with China. So yeah, I mean, the recession, the money's tight, and the ECB's getting it tighter. Banking conditions are reasonably tight. They're getting very tight in the States. And the rule of thumb is, and it pretty much always works, wherever the US goes, so Europe follows. So it's on its way.
Okay, so delayed, I think, Chris, is your point. But so that's how you feel, but then you're long equities. You upgraded from neutral. So what's that about?
Well, that's more of a sort of tactical call. I mean, I think what's happened is, I mean, we're in this weird kind of stock market, and central bankers basically are in sort of slightly schizophrenic. Do they deal with monetary policy issues, or do they deal with financial stability issues? And whenever we get a blow up because they've tightened money too much, we get a blow up in the banks, or you had a blow up in the British pension system at the back end of last year. All of that reflects tight money, and they respond with financial stability tools and print money. So, you know, the reason we're overweight equities on a tactical short-term basis at the moment is basically because there's a lot of liquidity around, and it's pushing the markets higher. there's a lot of risk aversion, a lot of fear in mid-March, and it takes a while for that to come out of the system. I would say if you look beyond a couple of months, I would be bearish on equities, and in fact we are underweight on a strategic longer-term basis.
Well, to that point, the fact that the response to both what happened with UK pensions and SVB has been to print more money, and does that mean we basically move on, that the impact of these in terms of tightening credit conditions, that it just doesn't show up because of the reaction from policymakers?
Well, it goes straight to your question. Basically, it stretches the whole thing out. You can either do it quick and accept what tightening money does. It blows up banks and it causes problems and things happen and the system therefore picks it up and it works its way through the system. Or you can try and offset it every time there's a problem. I mean, it's the old saying, isn't it? The Fed always tightens until something breaks.
Yeah.
But the reality is they keep tightening and things keep breaking and we ain't done yet.
Yeah, but I feel like this totally encompasses kind of the struggle, right? It's like you can be bearish on the economy or worried and like know that the worries are coming and tactically still have to buy stocks because or else you keep missing out on any kind of rally. That's super confusing, I can imagine, for someone in your position. What do you think is going to be the tipping point then that brings renewed pressure on the equity market? Is it going to be earnings? Is it going to be another bank failure? Like, what is it?
Well, we're working our way towards recession. It's quite interesting in the last month or two, the correlation of equities and bonds has changed. Last year, equities and bonds sold off together. In the last month or two, particularly since the banking crisis, bonds have rallied typically as equity have sold off. So, that kind of correlation is telling you you're moving towards the point where the bond market's thinking more about recession dynamics. And that's natural, of course. With the banking crisis, you're going to tighten credit conditions further. You're going to accelerate the timing of the recession. So I think the key here is we need to price in recession into the stock market, into asset prices. We need to price in recession into earnings and a whole bunch of other asset classes actually. So I think it's coming, and maybe you get some sort of big blow up with that. I mean, it's very difficult to know, but frankly, we're unwinding 12 years of financial repression and zero interest rates. The idea you can do it without any blow ups and any major problems, it's all manageable, is kind of sort of cloud cuckoo land in my opinion.
Cloud cuckoo land, yeah, it does feel like that more and more frequently, Chris.
Yeah.
If I can take you even further into the future, past any recession we might have, what does the end of cycle playbook look like? Do you assume, as the IMF does, that we're going to get back to the lower bound range of rates?
Well, what does the end of cycle playbook look like? That's an extremely good question. It depends how much things blow up, basically, and how badly they blow up. So really the sort of same sort of question is how big might the recession be, how deep? And the case for a mild recession is well made. People make that case, a lot of cash around. But there's definitely a ton of risks that we have a deep recession. No one talks about the zombies. 5 years ago, that was all we talked about. Look at corporate insolvencies in the UK. They are already pretty much at record highs. We haven't even begun the recession. So, you think about the zombies, you think about the commercial real estate. Everyone's been talking about that in the last couple of weeks and months. And then you think about commercial banks' balance sheets. And I think at every level, every major level, the commercial bank's balance sheet is under pressure. Not just the commercial real estate, not just the losses on securities, but across the whole balance sheet. So, how does this thing end? Where do rates end up? It's a very big question. The point is, these things are somewhat unpredictable, but you can get a sense of where we're heading, I think, from all the challenges that come from unwinding 12 years of zero rates.
Right. Maybe when we finally escape cuckoo land, I think we're all looking forward to that.
Yeah, it's cuckoo land, it's Alice in Wonderland, it's the White Queen, isn't it? She can believe 6 impossible things before breakfast. And I mean, I think we've had more than 6 in the last 12 years.
I think that's right, Chris. The perfect metaphors for this Friday evening. Chris Watling, their Chief Market Strategist and founder of Longview Economics. Thanks so much for joining us. Now, coming up, we're going to head to the IMF spring meetings in Washington, which wrap up this weekend. Jim Chalmers, the Australian treasurer, joins us next. This is Bloomberg.
to take you back now to Washington, D.C., where the World Bank and IMF spring meetings are underway. Joining us now, Bloomberg Global Economics and Policy Editor Kathleen Hays, joined by Australia's Treasurer in a very rowdy area of the IMF spring meetings.
A lot goes on at the IMF and World Bank spring and annual meetings, and this is just a wonderful sort of almost noontime performance. But let's get right to the main attraction right now, and that's Jim Chalmers, as you said. It's wonderful to have you back, and I want to start on the independent review of the Reserve Bank of Australia, because it seems like it's due any time now. It could include things like more meetings every year, or fewer, I should say, a press conference after every meeting. Bottom line, are you close? Have you set a date? Are you ready? You made up your mind?
I'll be looking to release it really soon, hopefully in the next week or two. We've received the report from a really terrific panel. They've made some, I think, some very wise recommendations. I will confer with my cabinet colleagues. I'll also confer with the opposition and with the crossbench in the parliament to try and get an element of bipartisanship around the Reserve Bank review. I think it's a good opportunity for Australia and for its central bank to see what we can do better. And so that's the spirit with which I'll release it.
So is this more than tweaks? Is there some kind of shake-up here we're going to be seeing soon?
Oh, well, I think in order for it to be worthwhile, the recommendations need to be robust and meaningful, and they are. And so when I release it, whether it's in the next week or two, certainly before the budget on May 9, people will see the thought that's gone into it. And really the opportunity not to kind of second guess all of the decisions that have been taken in the recent past, but to try and work out if we've got the right objectives and processes and structures to make these really important decisions.
What objective would you change? You want to have price stability and an economy that grows. Would you change that?
Obviously inflation targeting is a really important role, and I wouldn't expect there to be substantial changes there, nor would I expect there to be a winding back of the independence of the Reserve Bank, which is a key feature of our central bank in Australia. But there are other meaningful changes which will be proposed, and I look forward to perhaps coming back on the program and talking about them when they're out in the wild.
We'll be glad to have you back. Governor Lowe has said that he would like another term. Have you made up your mind yet?
We've said both privately and publicly that in the normal course of events, an appointment which comes up in September would be considered closer to the middle of the year. And we also want to get this Reserve Bank review out there and considered and discussed and talked about and consulted on because that's an important part of the future of the bank as well.
In the past, you've expressed publicly support for Governor Lowe and the policies he's taken on inflation and more. Why wouldn't you keep Phil Lowe?
Well, I've said before, and I say again, I've got a really terrific working relationship with Phil Lowe, and that's really important. But I also cherish the importance, the centrality of the independence of the Central Bank of Australia as well. We take these decisions about appointments in the usual methodical way. In the normal course of events, that would happen towards the middle of the year, and that's what people will see.
The RBA softened its stance a bit, and I think another question for you, because you've been supportive of the inflation fight, is this the correct way to not get into sticky inflation that you can't get down?
Well, two things about that. I mean, first of all, in cherishing the independence of the bank, it means not preempting or second-guessing the decisions that they take. I've got my own job to do. But certainly in Australia, even as inflation is moderating, it's still more persistent than we would like. It'll be higher than we'd like for longer than we would like. And so whether it's the work of the Independent Reserve Bank or the work that I do in the budget with my colleagues, what we need to do is make sure that we are providing some cost of living relief in a way that doesn't add to inflation and make the problem worse.
Okay.
We lay the foundations for future growth, and we make our economy and our budget more resilient to global economic shocks of the kind we're talking about here.
What have you learned here? What have you heard? Conversations, Janet Yellen and others, a lot going on, war in Ukraine still going on, China's reopening. How has this informed your view of the possibilities and the risks for Australia's economy this year?
Well, first of all, the Ukrainian victory couldn't come soon enough for the global economy. I mean, that is the source. The Russian invasion is the source of so much human suffering and economic volatility, and so a good economic policy is an end to the war, first and foremost. But beyond that, the global economy is a precarious place right now. And it's characterised by uncertainty and volatility, and we take that very seriously, even as inflation moderates. We've seen spot fires in the banking system, which have been put out by the authorities. And so much of what we're talking about here is how do we align our domestic agendas and our budgets and our regulatory settings to be carefully calibrated to these difficult global economic conditions.
IMF slightly downgraded its global forecast, but said there are very big risks from the global banking crisis, or whatever you want to call it, that seems to have stabilized. Is this a concern, tighter lending conditions, not necessarily for your banks, but the reverberations to Australia?
Well, first of all, as I think you're acknowledging, Australian banks are very well capitalised, very well regulated, and very well placed to deal with this volatility. But obviously around the world, we need to make sure that whether it's supervision, whether it's stress testing, that it takes into account developments since the global financial crisis, particularly when it comes to non-banks and also when it comes to the speed of potential bank runs. And so my contribution here has really been to urge my colleagues for the full implementation of Basel III, but also to see where the speed of these developments is an additional concern so that we can get quicker and smarter when it comes to dealing with these problems.
Well, as you said, you're going to have that RBA review decision soon. You said before the budget on May 9th?
Before the budget, yeah, definitely.
So again,
ideally in the next couple of weeks, but certainly before the budget on May 9th.
And you're going to call Bloomberg and let us know so you can come back and announce it right here on Bloomberg Television.
I'll do my best.
Okay, Jim Chalmers, Treasurer of Australia. Back to you, Donnie.
Kathleen, thank you so much. And of course, thanks to the Australian Treasurer, too. I got to say, I never thought I'd see the day when the backdrop for an RBA monetary policy decision would be funk music. But hey, you know, there's a time and place for everything.
Total props for getting that done. That was tough.
Absolutely buzzing over at the IMF. All right, well, Alex, coming up, we're going to talk about Boeing, more problems for the 737 MAX, but this time it's on the production front. We're going to talk to Jefferies equity research analyst for airlines, aerospace, and defense. She'll join us next to explain. This is Bloomberg.
All right, Boeing stock getting hit pretty hard today. The company discovering a new manufacturing issue with some 737 MAX airplanes that's going to delay some deliveries. Southwest Airlines says it's going to reevaluate its flight capacity after learning about those delays. And it's just another setback for the company after a long global grounding of the 737 MAX. So joining us now is Sheila Kahyaoglu, Jefferies analyst for aerospace, defense, and airlines. She's a buy rating on Boeing with a 250 price target. Sheila, how much is this going to cost Boeing?
So that's to be determined yet. It's really early, and it's a pretty preliminary pause on deliveries. It's on all the variants with the exception of the MAX 9, and the MAX 9 accounts for about 15% of the current aircraft that are in the inventory and about 15% of the backlog. So stepping back, the MAX is no doubt the biggest free cash flow generator for Boeing. It's about 30% of the company's 2023 revenues, and we estimate with Boeing's current guidance of 400 to 450 MAXs, each MAX generates $10 million of free cash flow. So it is the biggest driver of Boeing's profitability and free cash flow profile. We'd say about 60% of that.
Wow.
Boeing had a great lead, as we were just talking about before we got on air. For a whole 24 hours, they surpassed Airbus for the first time in deliveries in Q1 of 2023. I think that lead had not been there since 2018. But of course, this setback, and we're going to see how long it lasts, and I think that's the biggest question.
So Sheila, just to put it really simply, can Boeing execute on their turnaround with this MAX 737 still paused at the same time?
No, they can't. Simply speaking, they need the MAX to generate cash flow. The MAX is 60% of Boeing's free cash flow. So now this is not a grounding like we saw a few years ago. This is not a safety of flight issue. What it is there's 3 manufacturers of brackets on the aft fuselage, and there's 8 brackets, and they're not conforming. Whether it's from, a paperwork process, which is more of a process issue, but probably as well as a product process as well. So that has to be improved, and then there will be rework for the aircraft that are in the inventory and the installed base as well. So there will be a cost to that, which we don't know yet because we don't know the extent of it. But it'll be how quickly can Boeing improve it. So let's not forget, going back to February 23rd of this year, the 787 had a non-conformity issue. It lasted 15 days, and they were able to restart deliveries on March 10th. So it could be a relatively short issue. Right now, we're making the preliminary estimate that it cuts about 20% of Boeing's deliveries for 2023, or about 80 of our 420 MAXs we expect to get delivered.
So Sheila,
it lasts about 3 months.
So Sheila, what about, though, existing just bad headlines? And I just bring that up because, Southwest saying it's going to reevaluate its flight capacity. Like, I can imagine that all of that's just going to trade heavy for the stock. The stock is down 5% in just 2 days. Like, what's a potential downside scenario here?
So this doesn't change the normalized free cash flow. Unless this is a significant issue, which if it was, the FAA would probably be grounding the aircraft. So I don't believe this is a significant issue, especially given that there's one supplier out of the 3 that is manufacturing it correctly. So we don't know yet who that manufacturer is, if they could ramp capacity quickly enough. So it doesn't necessarily change the normalized free cash flow profile of the company, but it clearly will impact 2023 estimates if this delay goes on for weeks and months.
Hey Sheila, I just want to jump in. I want to jump in because we're running short on time, and I want to ask you about a very European-specific question. Not that long ago, we had reporting that Airbus was looking at expanding in China, both factories and sales there. Quickly, how big of a story is China for Europe versus the U.S.? In less than a minute here, Sheila.
Sure. So our supply to demand model assumes that there was 1,000 narrow bodies produced in 2022. That number is slated to go up to 1,500 narrow bodies the world needs to be able to fly around the world with 4% air traffic growth. We estimate China's about 300 of that 1,500 global need. And right now, Airbus is giving them the entire 300. That is fine because there's still a lot more to do, and the global duopoly divides that 1,500.
Okay, Sheila, thank you very much. Apologies, we're just out of time. That's Sheila Kahyaoglu, Jefferies Equity Research Analyst for Aerospace, Defense, and Airlines. This is